What do you have?
Go past. So this is a Graham Stephan. Now, Graham Stephan, I guess he's a wealthy real estate guy in his his early 30s. I guess he became a millionaire in his 20s. He's a huge Dave fan. This is the guy that has the cardboard cutout of Dave Ramsey in his house.
Oh,
Takes pictures of it. So him and his buddy are interviewing Dave Ramsey and George Camel, or Skippy, as we like to call him. And they're asking about risk in return to debt. And we're going to analyze this because it's a little wonky. Not wonky, hinky, I think is probably the better term.
If your theories don't last. And so the only one I've ever found, and this comes back to my faith journeys where it started, the borrower slave the lender, I can find nowhere in Scripture that debt was used to bless people. And so then I got to think,
okay, if you're using Scripture to measure your risk, then I don't know what to tell you.
Okay, do I believe that, or do I believe my academic training? I've got a degree in finance. I know how to run an IRR, and I know what the IRR looks like with debt and without debt, and it's not nearly as good unless you're leveraged. But you can run an IRR through the roof with leverage. Guess what's left out of the IRR calculation? There's no math inserted for risk. The IRR.
Okay, that's not true. Okay. The last little math lecture for us. I'm not going to do math. I'm just going to give you how the equation works.
Just give us the rundown.
So here are the basic measures, some of the basic measures of risk. Okay. Alpha is number one. Alpha is just your return versus your benchmark or the market, right?
So my return versus the market.
Yeah. So the return of the investment you're looking at, right?
Sure.
Versus either the market or another benchmark, something I'm comparing it to. Okay. Beta is the correlation. Okay. So if we're comparing it to the market, right? The market would have a beta of 1. Okay. So it'd be multiplied by 1. If the comparing thing I'm comparing, the correlation, or not the correlation, but at least the relationship was 1.5 on the beta, well, that would mean for every 1% the market goes up, this would go up 1.5. Roughly, right? We're looking at some sort of historical values of fluctuation, right? If it's a 0.5 beta, for every 1 the market would go up, it'd go up half. Okay, so beta is it's a measurement of risk usually used for like business or project investments. Like our earlier example of you need $1 million and you want me to invest and you expect X return, right? What I would do is go, okay, what is the alpha, the expected return versus the market, right? What's the beta, right? Your risk factor versus the market, right? Are you going to fluctuate more than the market or less? Or whatever benchmark I'm comparing to. We're just using the market for now. Okay. This is, beta is a good tool for that kind of stuff. For stocks, not so much, because it's very short term. It's very short lived, right? And it can change at any minute, right? It doesn't have a good historical correlation. I'll show you that in a second. The third factor of risk on this is what's called R squared. This is just old statistics stuff, right? Basically, it's saying what's the causal link between the market fluctuations and the fluctuation of the investment, right? So what it's saying is our beta and alpha, does fluctuations in the market have a causal relationship to these things? Okay. To simplify that in terms is this. If the market fluctuates a lot, right, but Lacey's business doesn't, right? Or if the market goes up and Lacey's business goes down, but the market goes down and Lacey's all of a sudden shoots up, or Lacey's moves erratically compared, then there's no relationship between your business and the market.
Right.
Right?
There just might not be one.
Right. So the beta is now useless. Okay. Now, when he brought up calculating IRR and ROI, I put this under opportunity cost, but it's just a concept. So ROI is return on investment. IRR is the internal rate of return. These are related in what I talked about, the capital asset pricing model, if I'm making a comparison, right? Now, these are going to show you kind of what is the expected rate of return, right? Or the return I'm expecting. The other thing is when he says, well, debt isn't factored in. Well, these are the debt risks that are calculated. So when I do the IRR, I'm also going to calculate other risk relationships. So I'm going to look at your debt to capital, right? So I'm going to take your total debt divided by the amount of capital you have, the amount of money. Debt to equity, how much shares do you have outstanding, right? Debt to, what was it, interest coverage. Can you cover the interest on your debt, right? Degree of combined leverage. Well, what's your leverage combined versus what you can afford, right? And are you at higher risk? So this idea, he said, calculating the IRR, risk is never factored in. It is factored into the IRR through beta, but that's not going to tell you a ton about the debt. You got to look at these other factors. So I'm calculating the return based on whatever calculatable risk I have with beta. And then I'm going, well, wait a second. Okay, well, that's good. But Lacey has $20 million in debt. And she's, right, and her monthly payment on her debt is like $300,000. But her business is only making $450, and her operating costs are $150. So how does anybody get paid? Right. But if I look at it and I go, okay, well, wait a minute. Lacey's got $1 million in debt, and her debt payments or whatever, $20,000 a month, but she's making $290,000 a month. Well, now this is not such a big deal. This is a low risk. Your debt's not a big issue for me. In fact, your debt makes it more attractive. Right? Because you have a lot more room to get more debt if you need to expand quicker if things go really well, which means I'd make more money on my investment.
Right.
So there's other factors in here, right? So this idea that it's not factored in or anything, or that University of Tennessee might want to call him and say we want our degree back, because
Or that debt in of itself translates into risk is not necessarily entirely accurate. Like, you've got to give it context.
Right. The context
is absolutely critical.
It's imperative, right?
Yeah.
What kind of debt? How much debt? How much are you making? Right? In fact, if you were zero debt and you were throwing all your cash payments at it, all your money at it, I'd be sitting there going, well, that's eating away at your shareholder return, which is going to piss off your shareholders, which means people might start bailing out, which puts you at a higher risk of mismanagement, which is a business risk. Right? So there are these things all interplay. They're not like one doesn't affect the other. I mean, it's not like they exist in a vacuum, right?
Risk. It doesn't recognize it. And so
go back real quick.
And doesn't recognize it.
Right, hang on, let me go back 1 second.
There's no math inserted for risk. The IRR is agnostic to risk. It doesn't recognize it. And so while you see this great,
which is not true because beta's in there.
Return, there's zero risk shown up in there. The chance that you lose the thing, or the chance that the stress brings on your life, or what it does to your marriage, or what it does to your bodies to carry around the weight of that. None of that is parlayed into there. And real estate is unique in that way.
Those are good points, though. I mean, if somebody doesn't understand the risk and it's affecting their personal life, then you need to factor that in, right? And maybe doing the stupid thing is better for them personally. It does happen.
Why? Because other investment vehicles teach us to mathematically insert risk. For instance, two mutual funds, you would never compare an aggressive growth stock mutual fund with a growth in income. Okay, and if you look at the chart, the growth in income is kind of like this, and the aggressive growth is like this, right?
I don't know why you wouldn't compare them, but okay.
And that's the risk factor. And the highs and lows on that, y'all probably know this is called.
That's not the risk factor, but okay.
for our audience at home, the change, the rapid change, is measured by a thing called a beta. And a beta.
But knows that beta is the measure of risk for stocks, which it is typically not. You can use it, beta number 2, as a proxy for risk on stock investments, but they're short-lived, and I'll show you that in a second. Typically, what you use is this. It's called standard deviation. If we go back to our efficiency portfolio, right, the efficiency frontier here from Markowitz, standard deviation is what they're using for risk. That's how they measure risk on stock investments. The Sharpe ratio is also used that. So standard deviation, like I said before, it's the fluctuation from the mean, from the average, right? The Sharpe ratio is just that return minus the risk-free rate divided by the standard deviation. But any sort of measurement you're going to use on a stock is going to factor in standard deviation in some form. And to give you an example of beta versus standard deviation, I found a fun one here. So this is Lithium Americas Corp, LAC. Okay, so lithium, they make lithium for batteries and stuff like that. Okay, which is important for like electric cars, solar panels, things like that. So if we look at this, the green is LAC's return over the last 5 years, okay, in the market. This blue line here is the S&P 500, so our market return, right? If you look from 2018 over here to about July of 2020, the blue line and the green line move pretty much identically. Do you see that, Lace?
Mm-hmm.
So at this point, the beta would probably be about 1, right? LAC moves pretty much similar to the market, and most of its movements can be explained by the market's movements, right?
Right, but now tell us what's going on over here in this more recent time frame here, because it sure looks like it gets a lot bigger.
Right. Well, what happened is a lot of countries in Europe and now the United States are saying we're moving to entirely electric car fleets. So we need lithium batteries for these cars. So LAC got a bunch of contracts to make these batteries over the next 15 years, right? And this is fluctuation, is them getting the contract, maybe not getting a contract, getting a contract, maybe not getting the other contract, getting another contract. So it's gone up. So now, if you were going back to July of 2020, the beta is probably about 1, and the R squared is probably really high. There is a causal relationship between these two, right? But after that, it's completely random to the market. So they measure the 5-year beta for this LAC at 1.5, but it's worthless because it moves completely random against the market, because it's being affected more by its business risk than systematic risk, right? So using beta to measure risk on an investment is insane. You can use it on short-term kind of stuff, but if you're using it on anything realistic, it doesn't mean anything if the R squared is for nothing, which is the case here, right? So what would you use? Standard deviation. I would look at the mean, the average mean, and look at standard deviation and how it's changed over time to give me the volatility of the actual investment. So standard deviation, I could use Sharpe or I could use historical volatility, but I have to have standard deviation plugged in order to determine that. And it's important to understand that factor going forward that Dave doesn't seem to get. He seems to think, he doesn't understand, okay, beta, you typically use it for investment projects. Lacius is doing an investment project, wants $1 million, wants me to invest. I would use beta, and I would use capital asset pricing and R squared, and I'd figure out, okay, what do I think my return is going to be? And then I would look at, okay, well, what are the other risk factors? Her debt risk factors, business risk factors, and ask myself, is it worth it compared to something comparable, right? Mm-hmm. And that's how I would make that decision. LAC, I'm sorry, this is a little wonky, but I calculated this pretty quickly. So GSPC is the S&P 500 on the top here. So its standard deviation is about 1.4% over, what did I do just for the last few days? Or no, I did it for the last year, sorry. But it's been up and down, but it's been about a 1% standard deviation per year. So it's been pretty tight, right? But it's had a negative return of 19.73%. Okay. As where LAC has a standard deviation of 4.99, its beta is 1.5. So it should only be 1.5 times this 1.47, right? If it were correlated, right? If the R square was high, this standard deviation should only be close to about 2.5, 2.25. But instead, it's more than double that. And its year return is over 80% because they got all these contracts. So the beta doesn't tell you anything on that investment, right? The standard deviation does, and the change in standard deviation plus the direction, but you also have to go in and factor, well, what are the business risks? Do they get the contract? Do they not get the contract? That's going to affect the stock a lot more than the beta. The beta is not going to affect that at all because it's not correlated at all.
Right.
So, did you want to do this last one real quick?